What's up mga Marites? Buckle up for the new episode of ABV 21.1 radio station, ang radio ng mga future CPAs. Mga Marites, I am DJ Angelyn Acabal and I know all of you are all excited to hear our episode for today. So without further ado, let's get started. Today, backed by popular demand, we're going to discuss one of the business valuation. Dear listeners, the asset-based valuation is sometimes called the asset approach to business valuation. This approach encompasses a set of methods that value the company by reference to its balance sheet. Specifically today, you will learn the four methods under asset-based valuation. That is the book value method, replacement value method, reproduction value method, and lastly, the liquidation value method. That being the case, don't miss out and keep on listening.
Panyawan Herbal Capsule. Ako day si Fernando. Sukad atong nito Markog Panyawan Herbal Capsule. Nawala akong tuhod. Ang Panyawan Herbal Capsule ay mapalit sa inyong mga suking butika. So unsa imong ginahulat pa? Pag move on na kay dili jud ka kaya higugmaon sa taong imong gihigugma.
Ano di ko kaya bumitaw bigay masasaktan dahil
Hoy DJ, pag-share diha.
Now we're back in ABV 21.1 radio station. The first episode would be introducing the asset-based valuation. So this is applicable if the entire company is driven by its asset base. Because if that is the case, the value of the company can be best attributed to the value of its assets. One of the very first procedures in any closely held business valuation is to define the business ownership interest subject to valuation. So, in the case of the asset-based valuation, the information required includes the total value of assets, financing structure, such as total liabilities and total equity, and the classes of equity and other sources of funding. Aside from that, there are two important words in the asset-based approach valuation that we need to remember. The first is value and the second is total. So the asset-based valuation is based on the value and not the recorded balance of all the assets and all the liabilities of the subject company. So the value here means the investment value, owner value, and the use value. The second word is the total. The asset-based valuation is also based on the total of all the subject company's assets and liabilities. Those balance sheet record account balances are probably presented in compliance with GAAP, which typically includes combination of historical cost-based measures and GAAP-based fair value measures. Always remember that each of these value conclusions will be quantitatively different for the same company belonging to the same industry. And each of these business value conclusions will be perfectly appropriate in the right circumstances, usually based on the actual or hypothetical transaction that is being analyzed. Now the question is when to apply the asset-based approach. The relevant question is not when should I perform the asset-based approach, rather the relevant question should be when can I not perform the asset-based approach, because there are companies or type of businesses that are not applicable for this type of valuation. So here I will present some of the example of the companies that could be applicable for this type of valuation. Number one is, it is applicable to tangible asset-intensive companies and to intangible asset-intensive companies. And the second, this could also be applied to the valuation of asset holding companies and the valuation of asset operating companies. And lastly, the asset-based valuation is particularly applicable to the analysis of company acquisition that is structured as an asset purchase transaction as compared to a stock purchase transaction. According to some analysts, the selection of the applicable valuation must consider four primary factors. The first would be the type of the subject company. The second is the subject business interest, the subject transaction, and the availability of the necessary data. So regardless of the type of company that we are considering to value, as long as the result of the examination of the factor tells you that the asset-based valuation is more fit, then we should use it as the valuation. In general, the asset-based valuation is based on the principle that the value of the total company assets, both tangible and intangible, minus the value of the total company liabilities, both recorded and contingent, equals the value of the total company equity. That's it for our introduction of the asset-based valuation, and in a few seconds, you will hear more about the methods of this valuation.
Thank you, partner. Hi guys, DJ Mae in the house. Now let's start from the very basic of all methods, the book value method. Why do we call it book value? This is because the value of a particular account comes from the amount recorded in the books of the business. Under the book value method, the value of a business is measured using the book value, which is basically the amounts that is recorded in the accounting records, such as seen in the audited financial statements, specifically the balance sheet of the business. The current assets, cash and cash equivalents, receivables, and other assets such as non-current like PPE, land, as well as current liabilities, payables, and other non-current liabilities, etc., are all accounts seen in the accounting records, which are basis of measuring the book value of a business, company, or firm. Therefore, when we are solving for the asset-based valuation of a business using the book value method, we obviously use the book value. Now, the formula used in book value method or in getting the net book value per share of assets is we deduct total liabilities from total assets and divide the amount or the difference from the total number of outstanding shares. Looking at the formula, we get total assets by identifying and adding, of course, the current and non-current assets of the company. And in getting the total liabilities, we identify and add the current and non-current liabilities of the business. In here, we also need to take note that total assets minus total liabilities is actually the formula to get the net book value. Well, we still need to divide the net book value to the total number of outstanding shares in order to get the net book value per share of assets. Take note that the advantage of using the book value method is that it provides a more transparent view on firm value and is more verifiable since this is based on the figures reflected in the financial statements. However, the book value only reflects historical value or only based on what is recorded in the accounting books and might not reflect the real value of the business now. And now, to further understand how this method is applied, let us welcome DJ Elaine to give us some example problems. This is DJ Mae signing out.
Okay, thank you, DJ Mae. Now it's my turn to discuss the illustrative problem of the book value method. So,
Now this is my side. Listen, look, and listen, and learn.
okay, so please listen, look, and listen and learn. Okay, so ABV Corporation in the year 2022 presented their statement of financial position with the following balances. Current assets is 300 million.
Oh my God! Wow!
Non-current assets is 700 million. Current liabilities is 350 million. Non-current liabilities is 250 million. And the outstanding shares is 2 million. Now we have to compute for the net book value of the assets. So according to the formula, we first have to get the total assets and the total liabilities and then deduct. So total assets is 1 billion, total liabilities is 600 million, and when you subtract, it's 400 million. So this is our numerator. So, and our denominator is 2 million. So 400 million divided by 2 million is equals to, so the net book value
of the assets is 200 pesos per share. Now, I hope that this is clear and you have understood the concept and how to apply the book value method, because this is fairly easy. And allow me to reiterate that this method only reflects historical value. So, and it does not reflect future expectations. So, it might not reflect the real value of the business now. So, kung unsa man sa una, dili na mao ang value karon. So, we have to move on. Moving on are the special DJs to discuss their placement value method after a very short break.
Wow! Ganindot man diri! Bugnaw ug hangin kaayo!
Pwede pa kang mukaon bisag basta kagikan sa dagat. Sigurado malingaw ka diri sa Casa Corazon. Kuha sa may balay mong kasing-kasing.
Tako, pasapod kagikan sa dagat?
Wala rani. Nagtawas bitaw ko.
Maski nagtawas ka, basta gisingot, dako kayo ang tsansa na animahuli mong ilog.
Sa ato pawa epek akong tawas.
Karong gatrabaho na ta, dili pwede tawas lang. Kini ang atong pasaligan, nga kauban sa pagtrabaho, magriksona. O sa kapatak lang, kada butang, aron walay singot ug walay baho.
Okay kayo ni Bestie. Aron andam na ko sa tanang trabaho.
Aron walay singot ug walay baho, magriksona adlaw-adlaw. Isa ka sa shay, sulit sa isa ka semana.
Good afternoon, mga badi. This is ABV 21.1 Radio Station, ang station ng mga accountant. Preview. So for today's chismis is all about replacement value. Kung ayaw na, kailangan ng palitan. Charot lang. So we have special DJs as of today, July 4, 2022. Introducing DJ Ayco, ang DJ na soon to be CPA na human calculator. And yours truly, DJ Celis, ang DJ na CPA in transit na lumalaban. Enough with that, let's talk about what is replacement value. Stay tuned lang mga madi for us to learn new lesson for today's chismis. So replacement value refers to the amount that an entity would have to pay to replace an asset at the present time according to its current worth. Meaning, the amount of the similar thing that you want to replace is not the same amount when you originally acquired that thing. In short, ang value mo noon ay iba na ngayon kasi natuto ka na eh. Charot lang! With the same thought, according to the National Association of Valuators and Analysts, it is the cost of similar assets that have the nearest equivalent value as of the valuation date. It is also a method for determining what an insurance company will pay you in case your property is stolen or destroyed. For example, on the appraisers of insurance company, they have their own technique to determine the replacement value, to determine the appropriate insurance premium to be charged to their clients, or if opted to get a coverage lower than its replacement value, insurer will only reimburse the amount being covered. For example, ikaw ba ay nasapian ng tatlong duwende at gusto mo maging katulad ni Albert Einstein? Well, ito ang life hack para sa iyo. Magbisikleta ka sa park at magdala ng stick. Ilagay ang stick sa gitna ng gulong. Voila! Sira na ang bisikleta mo. Ang talino mo, madi. May replacement ka na ng bagong bisikleta. Moving on, based on that situation, the bicycle was purchased at 2,000 pesos 5 years ago. But because of the, let's say, fortuitous event, it has destroyed. Fortunately, you have received a replacement cost from insurance company which is 5,000 pesos. That's the concept of replacement value, in which the amount yesterday is not the same amount today. There are also factors that affect the replacement value of an asset. We have here the age of the asset, the size of the assets, and then the competitive advantage of the asset. First, we have the age of the asset. It is important to know how old the asset is for the evaluator to determine the costs related in order to upkeep a similarly aged asset and whether assets with similar engineering design are available in the market. Second, we have to consider the size of the assets. It is also important for fixed assets, particularly real property, where assets of the similar size will be compared. Some analysts find that the assets can produce the same volume for the assets of the same size. And lastly, the competitive advantage of the asset. Assets which have distinct characteristics are hard to replace. However, the characteristics and capabilities of the distinct asset might be found in similar separate assets. Some valuators combine the value of the similar separate assets that can perform the function of the distinct asset being valued. As to the replacement value in comparison to other values, replacement value is lower than the actual amounts invested, as the price of acquiring an asset of a similar condition typically decreases over time. It is also higher than the liquidation value, as replacement value does not include a distress discount, and higher than book value, as for accounting purposes, assets tend to be depreciated more quickly than they age. There are also drawbacks in the replacement cost method. It is often considered a deficient method of valuing a business, as it assumes that it is possible to reconstruct the value of the entire investment simply by replacing its physical assets. It does not incorporate a business goodwill. In the words of one investment treaty tribunal, the replacement value approach to valuation looks to what the investor has put in, not what the investor could expect to derive from the investment. Due to its drawbacks, the replacement cost method is rarely used as a primary method of valuing a business on a going concern basis. As Ripinski and Williams write, for the purposes of valuing a business, asset-based methods such as the replacement cost method generally produce a less reliable result than income-based or market-based methods and are only used when these other methods are considered inappropriate. So the use of the replacement cost is appropriate and can be applied when valuing startups where projections of future cash flows are deemed insufficiently certain. Asset-based approaches can also be used in certain circumstances to value companies that have gone into liquidation and will never operate again. So we have here the formula of the replacement value per share. So it equals to the net book value plus or minus the replacement adjustment divided by the outstanding shares, wherein the net book value, which was discussed by previous TJ, that net book value equals to the historical cost of an asset minus the depreciation. So to understand and to apply this formula, let's welcome DJ Ayco.
Good afternoon, guys. I'm DJ Ayco, and I will be your radio commentator for the next couple of minutes. And DJ Celis had explained very well the concepts and theories of replacement value method. And I hope, guys, you have understand it deep in your heart. Tama ba, guys? Hindi ba ako wrong grammar? O sige, ganito na lang. Sana naisa puso nyo yung discussion ni DJ Celis kasi talagang humugot siya, sa discussion. Replacement kasi. So, okay. Now, I will be giving an illustration as to how exactly do we compute for replacement method. So look at the slide. We will still use the same given guys na ginamit kanina, 500 million current assets, 1 billion non-current assets, 1.5 billion total assets, 200 million current liabilities, and 700 million non-current liabilities, and 1 million shares outstanding. Para to clearly demonstrate lang guys the difference between different valuation methods. So to illustrate, following through the given information of Grapes and Vines Corporation, suppose that 50% of the non-current assets has an estimated replacement value of 150% of its recorded net book value, while the remaining half has estimated replacement value of 75% of the recorded net book value. With the given information, the equity value is adjusted. So, paano to guys? So, step 1. Calculate the replacement value of the affected items. If you're waiting for me guys na bumanat ng hugot, pasensya na kayo, wala ako nun. Kasi, how can I be replaced with somebody else if I do not have one in the first place? Diba? So that's the thing, and let's continue. Tandaan ninyo guys, ang sabi sa problem, kalahati raw ng non-current assets ay 150% raw ang replacement value at yung kalahati ay 75% naman ang replacement value. So guys, no, ganito siya computein. Yung first half, 1 billion times 50% times 150%, it becomes 750 million. The second half, 1 billion times 50% times 75%, it becomes 375 million. The next step is pag-add din mo yung dalawa. So 750 million plus 375 million is equals to 1 billion and 125 million. So this will be our adjusted total non-current assets. So di ba guys, may tumaas, may bumaba, pero ayos na rin yun kasi still at the end of the day, it was still a net increase. Kaysa naman ganito, you are priceless to me dati, but now, you are worthless to me. Di ba dito may impairment? Ang sakit naman nun. At ang mapait pa nun, kahit na impaired ka na, worthless ka na, wala ka ng halaga sa kanya, hindi ka pa rin deductible for taxation purposes. Bakit? Kasi nga, hindi naman yan related realized loss. As long as hindi ka pa niya dinispose at hawak-hawak ka pa niya, no deductions are allowed for taxation. Eh, diba sabi mo wala kang hugot? Eh, ano naman to? Well, hindi naman to applicable sa akin kasi nga wala ako nun. Para sa inyo lang to. So, hindi ito counted. And guys, I'm sorry, no? If I already have deviated too far from our topic. But the thing is, that is exactly what will happen if iba ang inaatupag mo. Like, for example, pag-ibig, instead na mag-focus sa pag-aaral and particularly this topic. No? So, again, the total adjusted non-current assets is 1,125 million. So, step 2, add back the unadjusted components. Non-current assets lang naman ang inadjust natin to its replacement value. Our current assets remain intact as it is. This replacement value is used to revalue fixed assets, particularly real properties. But I've never seen yet that this replacement value was used to revalue current assets. And this is also the case in this illustration. So 1,125 million plus 500 million is equals to 1,625 million. That will be our total adjusted assets. So next, step 3. Reduce it with the total liabilities. So 1,625 million minus 900 million is equal to 725 million. That's the residual value. Next is divide it with the total outstanding shares. So 725 million divided by 1 million shares is equals to 725 pesos per share. And that will be our replacement value per share. So diba, this is how easy for us to solve for replacement value. That is also how easy for you to be replaced with somebody else. So, okay, wala yung joke. So that's it guys for replacement value method. I hope you have learned something. DJ Aiko out, and let's welcome our next DJ. Thank you.
Magandang afternoon to you listeners. Welcome back to the new segment of ABV 21.1 Radio Station, ang radio ng mga accountant. This is DJ Kimi, your DJ is so pretty, signing in. And now, we will be tackling about one of the asset valuation method, which is the reproduction value method. I know what you're thinking, but nah, this isn't the reproduction that you are thinking. However, we can associate the reproduction that you are thinking to our topic, which is the reproduction value method, so that it will be easy to retain the knowledge that we will be getting in this in tackling this topic. So now let's define what is a reproduction value. So before that one, diba, when we talk about reproduction, it means making or creating an offspring or a baby, diba? That is reproduction. However, here in reproduction value, it is an estimate of cost of reproducing, creating, developing, or manufacturing, in this case, a similar asset and not a baby. So that is the association between the why this is called a reproduction value method. So sorry for that. And now, when are we going to use the reproduction value method? So, there are instances that assets are highly specialized in nature. So when we talk about highly specialized in nature, there are assets that has a unique feature. So if they have a unique features, it most probably not readily available in the market. So when it is not readily available in the market, there will be lack of market information. Therefore, we cannot use the one of the asset based valuation, which is the replacement value method, because in replacement value method we will be using the cost of similar assets. But here in reproduction value method, these are useful for the assets that don't have any similar assets in the market. So since, as I've talked to you a while ago, there are some assets that are highly specialized in nature, which means it is very unique. So there are no, what do you call this one, there are no like there are no copies of such assets. So for example, there are manufacturing companies that creates their own machineries for the improvement of their operations. So those kinds of machineries are only useful for their operations and not offered in the market. So those kinds of assets cannot be valued through replacement value method, but can be valued in the reproduction value method. So this method requires a reproduction cost analysis, which is internally done by companies with assets developed internally. So this method is useful when first calculating the value of new startup business, most especially if you are going to enter in such industry that are very unique. So second one is ventures that use specialized equipment or assets. So as I've explained to you a while ago, so those assets that are very unique, which has no similar assets offered in the market. So reproduction cost is useful in these kinds of assets. So next is firms that are heavily dependent on intangible assets, and lastly those with limited market information, because of course you cannot use replacement value method if you lack resources in information. So however, the challenge in using this approach is the ability to validate the reasonableness of the value calculated. So, as I've said, there is a lack of there is a limited information resources, market information resources, diba? So, how are you going to assess if your what you call this one if the value that you calculated or you've come up with is reasonable enough, knowing that knowing na you cannot benchmark those values, dili ka makakompare since of course there's a limit of resources. So that is the challenge in using reproduction value method. So these are the steps in determining the equity value using the reproduction value method. So first is the step 1, which is to conduct reproduction cost analysis in all assets. So the step 2 is adjust the book values to reproduction cost values, which is similar to the replacement value method. So step 3 is to apply the replacement value formula using the figures calculated in step 2. So in previous discussions, the replacement value formula is being discussed. So I will just tell you what is the formula. So the formula is replacement value per share is equal to the net book value plus or minus the replacement adjustment over the outstanding shares. So that is the replacement value formula. So that is the formula that you will use in getting the reproduction value in reproduction. For the computation of the reproduction value method, we will have DJ Kean live on air.
Thank you, Miss Khymverly Gerardo.
Good day mga madi, this is Carias and I will continue the report of Miss Gerardo about revaluation value method. So I'll present to you the example of this method. So let's start. To illustrate using the information of Grapes and Vines Corporation, suppose that it was noted that the 80% of the total non-current assets are cheaper by 90% of the book value when reproduced. 20% of the total non-current assets are comprised of goodwill, which upon testing was proven to be valued correctly. So the first step, just like what Ms. Gerardo discussed to you earlier, is to conduct a reproduction cost analysis to all assets. So it's noted that 80% of the total non-current assets, if reproduced, is equal to 90% of its value. So we must identify the affected non-current asset first. So this is how we do it. So given na ang 1 billion, diba sa previous nga reporters, given na siya, yatag na ang 1 billion nga non-current assets. So atong pangitaon ang affected nga non-current assets. So giingon diring sa note kanina sa lower left nga 80% of the total non-current asset. So muna siya ang affected nga non-current asset. So i-multiply na to ang 1 million sa 80% nga giingon nga affected. So makuha na to ang affected non-current asset, which is 800 million. So since the remaining 20% or 200 million is goodwill and already in its proper value, then it will not be adjusted. So let's go to the next step. The next step is to adjust the book value to reproduction costs. So we will get the reproduction cost. So this is how I do it. Nakuha na nato ang non-current assets nga affected nga 800 million. Then di man nato sa previous slide nga 90% mo ang giingon nga cheaper siya. Ang 90% mo ni siya ang as if mauni ang percentage sa cheaper amount sa affected na non-current asset. So ang affected nga non-current asset which is 800 million, i-multiply na siya sa 90%. So makuha na to ang reproduction cost which is 720 million. Then after that, i-add na to ang mga wala na affected nga non-current asset and current asset. So reproduction cost, i-add na to ang goodwill. So makuha na to ang total non-current asset which is 920 million. Then i-add na to ang current asset nga 500 million. So ang total asset nato is 1,420 million. So let's go to the next step and the last. The last step is to apply the replacement value formula using the figures calculated in the preceding step. So the formula is reproduction value total assets minus total liabilities divided by the number of shares. So in this case, ang total assets nato is 1,420 million less 900 million nga liabilities. Then i-divide na siya sa number of shares which is 1 billion. If i-minus na to ang total assets ato ang total liabilities, so ang equity dire is 520 million. So i-divide na siya sa number of shares, then makuha na to ang reproduction value which is 520 per share. So nakuha ra ba tanan mga madi? Kung nakuha, then ay okay. So that would be all, and thank you for listening.
Good day, Marites! You are tuning in at ABV Group 21.1. This is your radio station for accounting. Hello, listeners. Hello, world. This is your DJ Vanessa. Together with me is DJ Nisa. I'm here to give you some tea. Yes, a tea you're all waiting for. To give you a clue, just listen to this. Yes, we are listening to the liquidation value method. This is our tea for today. We have 5 objectives. I know you're all excited to hear this. But first, what is liquidation value? So, without further ado, let us give our floor to Mr. Whitey.
Liquidation value. Liquidation value is the estimated total worth of a company's tangible assets in the event the company goes out of business. A company's liquidation value can tell how much the physical items that the company owns are worth after they've been bought at market rate, have been used and depreciated, but are not completely scrap. You should know your company's liquidation value if you think you might need to sell it fast. Knowing your liquidation value ahead of time will be a great value to you. It gives you confidence when making financial decisions, especially if you ever field offers to buy your business from an outside investor.
Well, now that you already know the definition, let us have a quick break.
Haplos, haplos, ayos. Kaibigan kasama sa ginawa.
We are back. So, liquidation value method. Liquidation-based valuation method is an alternative approach commonly used when the business is not a going concern. it is under the assumption that the business is not a going concern. But first, what is a going concern? A going concern assumes that the business will continue to operate indefinitely. Indefinitely because when we think of it, no one wants to close a business, right? Do you know someone? I guess not. But so it is an alternative approach because we need to value the company because it is insolvent. So insolvent is not operating in a going concern. So the going concern valuation is not appropriate in this situation. That is why this is an alternative approach. So liquidation value refers to the value of a company if it were dissolved and its assets are sold individually. So this is according to CFA Institute. We already know this term, right? It is not a new term for us because it has been discussed from our previous subjects. Next is, it represents the net amount that can be gathered if the business is shut down and its assets are sold piecemeal. So take note, net amount and sold in piecemeal. So sold per piece. Next is liquidation value should not be used to value profitable or growing companies. We will only use this to businesses that are shutting down, not businesses that are profitable. Okay, remember, this is not appropriate for profitable businesses or growing businesses. It should only be used by dying or losing companies where liquidation is imminent. So next is liquidation value should consider valuing separately the goodwill attributed to partner-specific qualities in the case of a partnership business model, as this may not reflect the true value of the assets which will be sold or transferred. Next are the situations to consider liquidation value. So they presented three, but first let us talk about business failure. So early symptoms is low or negative returns, or lower than the cost of capital, except to those businesses that are just starting because a new business can only recover 2 to 3 years depending upon the type of business. Going back to those businesses that have been in the long run, so when this happens, this is one of the early symptoms. So we have here insolvency and bankruptcy. We have to differentiate these two. So insolvency, it is the inability to pay liabilities when they fall due. And this means a business cannot pay in a short time but can pay in the long run or maybe next month, for example. Next is insolvent companies have asset balance which is still greater than its liabilities but is having liquidity problems as a result of depleted cash. So in short, asset is still greater than liabilities. And for the bankruptcy, inability to pay liabilities unless the assets are sold at a higher price than its book value. In short, the business cannot pay if they not sell the assets they have. Next is bankrupt companies have liabilities that are greater than its asset balance, thereby generating a negative balance in its shareholders' equity. In short, liability is greater than the asset. Next are the drivers of business failures. So we have here two, internal factors and external factors. So first, internal factors. Example for mismanagement are owners that doesn't know how to manage your business or they have poor decision making. And next is poor financial evaluation and decisions. Example for this is that no concrete plan, no forecasting, no feasibility study. Next is failure to execute strategic plans. So, strategic plans are not performed by the top management, such as or else strategic plans are not executed. Next is inadequate cash flow planning. This is important because it is where we'll get our money for payments. Next is failure to manage working capital. Next is the external factors, severe economic downturn. So example for this is during the Great Recession, where there is a sharp decline of economic activity and it is beyond the control of the company. Next is the dynamic consumer preferences. So it is the constant change of preference by consumers. Next are the material adverse governmental action or regulations. So this is not controlled by the company because it is controlled by the government. Next is the occurrence of natural disaster or calamities. An example of these are those businesses in Batangas when Taal volcano exploded. Next is the occurrence of pandemic or general health hazards. So, the example of this is the coronavirus lead to businesses closure as what we have experienced. So note, liquidation value can be used for businesses which are closing, are closed, are in bankruptcy, are in industries that are in irreversible trouble. Example, businesses in the Ukraine and Russia. And 5. Going concern, firms that aren't putting its assets to good use and may be better off closing down and selling the assets. So that's it for my tea. But before I go, I'll leave you a quote: if opportunity doesn't knock, build a door, by Molton Burrow. Thank you for listening. This is your DJ Vanessa signing off. We'll have DJ Nisa.
Babangon tayo, susulong tayo, babangon tayo, susulong tayo.
All right. Good afternoon, dear listeners. Live today is DJ Nisa of ABV 21.1 signing in. This will be our last segment for today's session. Please stay tuned as we will cover another important concept on the liquidation-based valuation method. Of course, I'll give you the topic outline for today's session. First, we'll tackle the general principles pertaining to liquidation value. Next, we will also cover the types of liquidation value. And lastly, we will solve some problems in relation to what we have covered. Now, dearest listeners, let's begin. What are the principles of liquidation value? In the first bullet, we will consider two factors. If the liquidation value is above income approach, which is based on the going concern principle, and if the liquidation comes into consideration, or the business entity plans to liquidate, then liquidation value should be used. The second one, if the nature of the business implies a limited lifetime, for example, quarry, grave, fixed-term company, etc., the terminal value or the present value of all their cash flows at a certain point, assuming a stable growth in perpetuity, must be based on liquidation. All costs necessary to close the operations should also be considered and deducted to arrive at the liquidation value. Remember, in partnership liquidation, we also have liquidation expenses, which are the expenses incurred in closing the business. So, the same goes here. We're also utilizing expenses necessary in closing the business, like plant closure costs, disposal costs, rehabilitation costs, etc., which will be deducted to arrive at the proper amount, which in here equates to the liquidation value. The third one, non-operating assets, mga asset nga wala gigamit sa operation like unused land or spare equipment, should be valued by the liquidation method as the market value is reduced by cost of sale and taxes. Since they are not part of the firm's operating activities, it might be inappropriate to use the same going concern valuation technique used for business operations. If result is higher than the NPV of cash flows from operating the asset, the liquidation values should be used. Lastly, liquidation valuation must be used if the business continuity is dependent on current management that will not stay. Not at all circumstances, people will stay, di ba? Why choose to stay if you're no longer happy? Wag bigyan ng meaning ha? This is just related to the topic. If the management is contented and happy with the top management's supervision or with their work, they might stay. But when they feel like the company cannot survive any longer, that's a different thing. They're just like rank and file employees who choose to stay when they like what they're doing and if the working environment is quite good. However, if this is a family-owned corporation, of course, in most cases, the management will opt to stay longer. Okay? That's for the general principles of liquidation valuation. We're down to topic 2, which will be all about the different types of liquidation. Of course, it is important for us to identify or determine the type of liquidation, since it will affect the costs connected with liquidating the property, including commission costs for those facilitating the liquidation, and of course, taxes at the end of the transaction. The first type of liquidation is orderly liquidation. Assets are sold strategically over an orderly period to attract and generate most money for the assets. This exposes assets for sale on an open market with a reasonable time allowed to find a purchaser, both buyer and seller having knowledge of the uses of the and process to which the asset is adapted and for which it is capable of being used. The seller being compelled to sell and the buyer being willing but not compelled to buy. So in this type of liquidation, we can infer that the process of liquidation is planned and reserved. Planned because the sale of asset is not in a rush. In this liquidation type, we can also say that it is reserved. Reserved for specific person mga kaila sa ihang true value. The asset selling price is properly valued in here. So there will be a meeting of minds between parties. Assets are sold at the right timing and at the right buyer. The second type of liquidation is forced liquidation. Assets are sold quickly as possible. Example, auction or rush sale. So, this is done immediately and assets are sold in the market as the soonest possible time, which result in the lower prices of a rush sale. This is a paradox of the orderly liquidation. In here, assets are sold in the earliest time as possible. So, if the orderly liquidation can be properly valued, in here, we can say that the assets are undervalued since they're on a rush, nagmamadali. Whoever acquires first may be the person who'll buy it. So, we can conclude that assets are not sold at the right time and at the right buyer in a first liquidation. Now, we're in the last portion of our afternoon session, the calculation of the liquidation value. The liquidation value considers the present value of the sums that can be obtained through the disposal of the assets of the firm in the most appropriate way, net of the sums set aside for the closure cost, repayment of the debts, and settlements of all liabilities, and net of tax charges related to transaction and other costs of the prices of liquidation itself. Liquidation value can be further computed on a per share basis by dividing the total liquidation value by outstanding ordinary shares. Liquidation value per share should be considered together with other quantitative and qualitative metrics to justify business decisions to be made. The formula will be present value of the sale of assets less present value of cost for termination and settlement for liabilities less present value of tax charges for the transaction and other liquidation costs. So the difference will be the liquidation value. Let's have a sample illustration. ABV Company reported the following balances in its books. ABV Company has 250,000 outstanding shares. For the asset portion, we have here cash of 100,000, accounts receivable net of 800,000, inventories 3.5 million, prepaid expenses 100,000, property, plant and equipment net 4.5 million with a total assets of 9 million. On liabilities portion, we have here the notes payable of 1.2 million, other liabilities of 800,000 with a total liabilities of 2 million. ABV Company is undergoing financial problems and management would like to assess the liquidation value as part of their strategy formulation. Just by looking at the figures, can we tell that the company is undergoing financial problems? If you're going to use the ratio analysis, we can tell that there is a problem in liquidity. Look at the cash balance of 100,000 and assume that all liabilities are current, which is 2 million. If you're having a 100,000 cash, how can we pay the 2 million liabilities? If assets are sold, they will only realize the amount based on the table below. To compute for the adjusted value of the assets, the current book values should be multiplied by the assumed value if they are liquidated. For cash, we have here the book value of 100,000 multiplied by the assumed value of 100%, which gives us the adjusted value of 100,000. Accounts receivable net, book value 800,000 multiplied by 85%, so it's 680,000. Inventories 3.5 million book value multiplied by 60% equals 2.1 million. Prepaid expenses 100,000 book value multiplied by 25%, so that's 25,000. Property, plant and equipment net 4.5 million multiplied by 60%, that's 2.7 million, with a total asset adjusted value of 5,605,000. Next, the liability should be deducted from the asset adjusted value to arrive at the liquidation value. So the asset adjusted value is 5,605,000 less total liabilities to be settled 2 million. So the liquidation value is now 3,605,000 divided by number of outstanding shares 250,000. So the liquidation value per share is 14.42 pesos. Let's go to illustration number 2. ABC Company, which is a company specifically created for a joint venture agreement to extract gold, will end its corporate life in 3 years. Net cash flow expected during the years it still operates is at 3 million per year. At the end of its life, ABC Company estimates to incur 10 million for closure and rehabilitation costs for mining site and other costs related to the liquidation process. Cost of capital is set at 10%. The remaining assets by the end of the corporate life will be bought by another company for 30 million, and the remaining debt of 4 million will be fully paid off by then. If the valuation happens now, compute for the value of ABC Company. Since ABC Company will terminate its life after 3 years, it is more appropriate to use the liquidation value as terminal value input to the discounted cash flow model. For the 3 year prior to closure, ABC Company will continue to generate positive net cash flow, and this will form part of its value. Below is the information made available to the present value of cash inflows during years in operations. Present value of annual net cash flow equals net cash flow times present value factor of 10%. Remember the present value of one formula? Its present value equals 1 over 1 plus rate raised to n. Going back, the computation will be as follows. Let's take note that ang use nga present value factor pag-solve array kay katong dili rounded off. Kung rounded off, let's say in year 1, that's supposedly 2,727,300. But for uniformity and accuracy of information, let's just use the whole value. So present value of net cash flow, year 1, 3 million times 0.1991. So that equals to 2,727,273. Present value of net cash flow in year 2, 3 million times 0.8264. So the total is to 2,479,339. Present value of net cash flow from year 3 equals 3 million times 0.7513 PV factor. So that's 2,253,944. So the present value of cash inflows during years in operations equals 7,460,556. Since corporate life ends by year 3, the terminal value will be based on the liquidation value by end of year 3. Present value of sale of assets equals 30 million times 0.7513, so that equals to 22,539,000. Then less present value of cost for termination and settlement for liabilities, so that's given in the problem, 10 million times 0.7513, so that's equal to 7,513,000. Last, present value of tax charges for the transaction and other liquidation cost. This 4 million is also given in the problem, so multiplied by 0.7513 PV factor, so that's 3,005,200. So the total liquidation value is 12,020,800. So cash flows during the remaining years of operating life and liquidation value by end of year 3 should be combined to arrive at the value of ABC Company now. So present value of cash inflows during years in operations, 7,460,556, plus the liquidation value of 12,020,800. So the total will be the value of ABC company, which is 19,481,356.
Parang kailan lang ang mga pangarap ko'y kahirap abutin. Dahil sa inyo, napunta ako sa aking nais marating. Nais ko kayong pasalamatan kahit man lang sa isang awitin. Parang kailan lang ang mga pangarap ko'y kahirap abutin. Dahil sa inyo, narinig ang isip ko at naintindihan. Kaya't itong awiting aking inaawit, nais ko'y kayo ang handugan.